Here's something that should genuinely bother you. Warren Buffett, the man who turned $10,000 into $100 billion over 6 decades, has been asked hundreds of times what the best book on investing is. Every single time, he gives the same answer. The same book, the same answer. The Intelligent Investor by Benjamin Graham, published in 1949, before most of the people watching this were born. He doesn't say a fintech newsletter. He doesn't say a podcast. He doesn't say whatever's trending on financial Twitter this week. He says a 75-year-old book written by his college professor. And yet, the average American investor in 2026 is making decisions based on Reddit threads and TikTok breakdowns, and tips from someone in their office who made money on one stock in 2021. My name is Jeff. Today we're going over the 5 rules Buffett learned from that book, the ones he's called the bedrock of every investing decision he's made for over 60 years. In a 2014 shareholder letter, Buffett wrote, "The key points were in chapters 8 and 20. That letter was written when he was 83 years old, managing hundreds of billions of dollars, still citing a book he first read in 1950. That's not nostalgia. That's a signal. The Intelligent Investor isn't a book about stocks. It's a book about how human beings behave when money is involved. The fear is the same. The greed is the same. The impulse to follow a crowd never goes away. The rules work because the psychology they're designed to counteract never goes away. Rule 1. Mr. Market is your servant, not your guide. Chapter 8 of The Intelligent Investor introduces a parable. You own a small stake in a private business. Your business partner, Mr. Market, shows up every single day with an offer to buy your share or sell you his. Some days, Mr. Market is ecstatic. Sky-high offer price, nothing but growth ahead. Other days, he's terrified, selling his share for almost nothing. His mood swings are extreme and completely unpredictable. Mr. Market's daily offer doesn't change the value of the underlying business. The business keeps operating regardless of whether Mr. Market is euphoric or panicking. When markets dropped 34% in March 2020 in roughly 3 weeks, the underlying businesses, their factories, customers, cash flows, didn't lose a third of their value overnight. Mr. Market panicked. The businesses didn't. The Intelligent Investor uses Mr. Market's mood swings as opportunity, not as instruction. Rule 2. Know whether you're investing or speculating. Graham's definition of investment: thorough analysis, safety of principle, adequate return. Everything else is speculation. Buying a stock because a colleague mentioned it at lunch is speculation. Buying a stock because it went up 40% last quarter is speculation. Buying cryptocurrency because a content creator says it's going to the moon is speculation. None of these involve thorough analysis of underlying value. All of them involve hoping someone else will pay you more than you paid. Buffett famously avoided investments he didn't understand, not because he couldn't learn them. Investing without thorough analysis of the underlying business isn't investing. It's gambling with extra steps. Is this based on analysis of actual value, or a hope about what someone else pays you later? Rule 3. Always demand a margin of safety. Even a great company at the wrong price is a bad investment. The margin of safety is the gap between what a business is actually worth and what you pay for it. Buy a business worth $100 for $60, and you have a $40 margin of safety. That gap doesn't just increase your potential profit, it protects you from being wrong. Buffett's bridge analogy. You build it to carry 30,000 pounds, but only drive 10,000-pound trucks across it. That same principle works in investing. Let's make margin of safety real with actual numbers. 1999, the dot-com bubble peak. Cisco Systems was trading at roughly 200 times its earnings. Cisco wasn't a fraud. It was one of the most important technology companies in the world. The business was real, but the price embedded almost no margin of safety. Investors were paying for decades of future growth, in advance, at full price. By October 2002, Cisco's stock had fallen 86% from its peak. Not because the business collapsed, Cisco's revenues kept growing throughout. Because the gap between price and value was so extreme, that any disruption was catastrophic. 25 years later, Cisco's stock has still not fully recovered to its 2000 peak in inflation-adjusted terms. A quarter century of waiting for investors who bought a genuinely good business at the wrong price. Margin of safety isn't pessimism. It's the structural protection that separates investing from hoping. If this is reshaping how you think about price versus value, give it a like. It helps more people find this. Rule 4. Decide which type of investor you are, and don't pretend to be in the middle. The defensive investor prioritizes avoiding serious mistakes, wants freedom from constant decision-making. A simple, diversified, low-maintenance portfolio. What Graham called low-cost index funds with dollar-cost averaging. The enterprising investor is willing to put in significant time and analytical work. Reading financial statements, understanding businesses deeply, doing thorough analysis. Both approaches are valid. What Graham explicitly warned against was the middle path. Half-committed stock picking is the worst of both approaches. You spend the time of an enterprising investor without doing the work. You take the risk without the analysis. Pick one lane and stay in it. Rule 5. Your biggest investment risk isn't the market, it's yourself. The investor's chief problem, and even his worst enemy, is likely to be himself. To invest successfully doesn't require a stratospheric IQ or unusual business insights. What's needed is a sound intellectual framework and the ability to keep emotions from corroding it. Fear when markets fall, greed when markets run. Both are guaranteed to arrive repeatedly throughout any investing lifetime. Both will feel like reasonable responses to real information. They aren't. They're Mr. Market knocking on the door. The investor who buys based on analysis and holds based on that same analysis. Ignoring the daily price offers from Mr. Market unless they create an opportunity. Is the investor Graham and Buffett describe. Everything else is noise dressed up as information. Here are the 5 rules one more time. Mr. Market is your servant, not your guide. Use his mood swings as opportunity, not instruction. Know whether you're genuinely investing or speculating, and be honest about which one you're doing. Always demand a margin of safety. Great companies at terrible prices are terrible investments. Decide whether you're a defensive or enterprising investor. Commit fully to one path. The greatest threat to your financial future isn't the market. It's the emotional reaction the market is specifically designed to provoke in you. Buffett read The Intelligent Investor for the first time in 1950. He has described it as the best investing book ever written every year since. 75 years later, the rules are identical. That's not coincidence, that's durability. This content is for educational purposes only and is not financial advice. If this helped, subscribe. And drop a comment with which rule hit hardest for you. See you in the next one.